Welcome. Subscribe to AS Foundation, India's leading academy for CA course, and hit the bell icon to get the latest updates. Thank you.
Now come to next part of this wonderful chapter about past event. Have you discussed past event? A past event that leads to present obligation is called obligating event. For an event to be an obligating event, it is necessary that entity has no realistic alternative to settling the obligation created by the event. Then it is called obligating event. Entity has no other alternative but to settle the amount. And this will be when either the obligation can be enforced by the law, means it is contractual, legal, or it is constructive. Constructive obligation means it creates a valid expectation in other parties that the entities will discharge the obligation. That is called constructive obligation. Several examples we have discussed. You are selling the goods and you take the goods back if the customer doesn't like. Over a period of time, this has been your practice. You give Diwali bonus to your employees. Constructive obligation. You allow employees to take some leave and you don't deduct their salary. Constructive obligation. Now you are creating an expectation. Okay. It is only those obligations arising from past event existing independently of the future action that are recognized as provision. Future conduct of the business will not give rise to obligation. Now one very good example is appearing. Penalties or cleanup costs for unlawful environmental damage, both of which would lead to outflow of resources embodying economic benefit in settlement regardless of the future action of the entity. If you have caused damage to the environment, unlawful damage, the law of the land says penalty will be levied upon the entity or it has to clean up the cost. It's a past event. You have no other alternative but either to incur penalty or clean up cost. So while calculating the amount of provision, you will take this into account. Which is more cheaper for you? Is it right? If you think penalty is simple, cheaper, pay penalty. A provision for decommissioning cost. Which standard we have discussed it? IAS 610. This standard also talks about it. Provision for decommissioning cost of an oil installation or a nuclear power station to the extent the entity is obliged to rectify damage already caused. In this chapter, we will not discuss about provision for decommissioning liability again. Refer IAS 610, where we have discussed cost model, revaluation model, etc. Now the interesting part is measurement of provision. Practical challenge. Measurement of provision. Why? Amount is uncertain. Timing is uncertain. But the standard says if the probability of obligation is more than 50%, you should make a provision. So the standard setter knows the practical difficulty. And he says make provision based on best estimation of expenditure that you will be required to settle the present obligation at the end of the reporting period. So on the reporting date, make the best estimate of the expenditure. Now how to make the best estimate of the expenditure? You have to imagine the amount, estimate the amount that entity would rationally pay to settle the obligation at the end of the reporting period or to transfer it to a third party at that time. So while making estimation, you have to be rational. Neither overestimation nor underestimation. Example. This can come as a separate question also. This example. An entity sells goods with a warranty, under which the customers are covered for the cost of repairs of any manufacturing defect that becomes apparent within first 6 months after the purchase. Now, what is the past observation? If minor defects were detected in all products sold, repair cost of 1 million would result. If major defects were detected in all products sold, repair cost would be 4 million. The entity's past experience and future expectation indicate that for the coming year, 75% of the goods sold will have no defect. Okay, no provision required for this. 20% of the goods sold will have minor defect. So for minor defect, you have to incur a cost of 1 million. And 5% of the goods sold will have major defects. So for that, you have to incur 4 million. Now, dear student, this can be a simple 4-mark question as a part of a bigger problem. How much provision would be required on the best estimate basis? So you will take first 75% into 0, 20% into 1 million, and 5% into 4 million. What is the final figure? Is it 4 lakh? So the entity will assess the probability of outflow as a whole like this. Use the statistical concept of expected value, which means this standard permits you to use statistical tools like expected value, where we estimate the amount that we may incur and the probability of that. Multiplying amount with probability of all possible outcomes and then taking a sum of it gives us called expected value. So if the company applies statistical tool like this, the answer will be it should make a provision of rupees 4 lakh. So that was an example on best estimate. Now the next is in the same paragraph, continue, point number 7 paragraph, presentation of provision. Presentation in 2 places, SOPL and SOFP. Okay. In SOPL, the presentation will be net amount. Presentation will be net. In SOFP, the presentation will be gross. What is net and gross? In SOPL, if we are going to suppose make a provision for warranty, I am a dealer. I directly deal with customer. I give him the warranty. And I have to make a provision of 3 million on the basis of goods sold in this year using that previous formula. But then I am not going to pay this from my pocket. I am just a dealer. The manufacturer tells me, you don't worry, but you are the interface between company and the customer. Whatever you will incur, we will reimburse you. And manufacturer says we will reimburse you 80% of this amount. So 2.4 reimbursement. Okay, spelling, forget. So what is the net amount you are going to write? 0.6 million as expense, because out of 3, 2.4 somebody else is paying for it. You are not paying for that. So therefore only 0.6. But while presenting in the balance sheet or statement of financial position, in the liability side, I will show 3 million. And on the asset side, we will show 2.4 million reimbursement receivable. Okay. And in case if this is having some doubt, then you can also disclose it in the notes also. But that we'll discuss in the disclosure part. So amount of provision should be shown as expense net of reimbursement. Amount of outstanding provision should be shown in the liability side without netting of reimbursement. Following points are to be noted. Important point number 1. Future operating losses. Provision should not be recognized. Why? Only past event. But you are taught concept of prudence in your school level accounting or college level accounting. You cannot overstretch the concept of future operating loss. However, future operating losses may be considered in checking the impairment loss. Okay, it is not a past event, forget it. Still, if you have to answer more professionally, then you will say you can consider it, but for calculation of impairment loss, if any, under IAS 36. Next line, review. Provision should be reviewed at each reporting date. Each reporting date, write down their reporting date instead of BS, reporting date. Now, what is the need for review? What is the need for review? Why just can't you can't keep it constant? Because provision, as you know, is an estimated figure. Provision is an estimated figure, and in IAS 8 also you have learnt, estimates can be revised based on new information, experience gained, etc. So therefore you need to revise the provision. What are the possibilities? Possibilities are provision may increase, provision may decrease, or it is no longer a provision. Okay. So then in that case you will remove it. Here you will change the amount. Okay. So the standard says if it is no longer probable, then outflow of resources will be required to settle the obligation. The provision is to be reversed. Provision can be reversed if you think we are not required to make any payment. So you have made a provision for warranty, 3 years are over, no customer turned up. Your goods are so good. Is it right? If you are selling Sony television, there is to my understanding, 99.999% chance nobody will come with any defect. So whatever provision, if at all you have made, you will have to reverse it. Okay. Or you may have made provision for court cases. Earlier you might have thought you would lose, but then you won the case and you may not have to pay anything, reverse it. Then future events that may affect the amount required to settle an amount of obligation should be reflected in the amount of provision that when there is a sufficient objective evidence that they will occur. Now these are the guidelines for estimating the amount of provision. Future events will be considered in estimation when there is an objective evidence that they will occur. And to understand this point, we will first read this example. Suppose you are into mining activity, and as we discussed in some previous paragraph, you have an obligation of decommissioning liability. You have to restore the environment, clean up the site, bring it back to the original situation. Now for that you will require expenditure based on technology you are going to restore the environment. So the standard says you have to visualize which technology you are going to use. Okay, what will be the cost of that technology, and accordingly make the provision. So that is called future event. Now while estimating the future event, there must be sufficient objective evidence. Means you are more likely to use this technology in future to clean up the site. The standard warns you, which I have not written, not required. You will not imagine a technology which does not exist only. That means the company cannot say, see, 10 years down the line I have to clean up the site. We expect after 10 years, there will be a technology which will reduce our cost by 50%. So what will you do as an auditor? Okay, we will check that at that time. Right now, whichever technology are available, choose the alternative you are going to use and make a realistic assumption about it. So that is future event. Next is risk and uncertainty that inevitably surround many events and circumstances shall be taken into account in reaching the best estimate of a provision. So that is, while estimating the provision, take into account the risk and uncertainty involved. That is, your estimates can go wrong and allow some premium for that also. This point we had covered in one small example. Effect of a possible new legislation. Okay, your year ending date is 31st March. There is a bill which is right now introduced in Lok Sabha. Government has majority in both the house of the parliament, Lok Sabha, Rajya Sabha. President is their own person only. Is it right? So what is the possibility that this bill will be passed? High probability. If you have majority in both the house, it's virtual certainty. And this law will have a retrospective effect. That is, the companies which have caused damage to the environment will clean up or pay penalty from retrospective effect. Your company has been causing damage to the environment. Is it right? The bill is virtually certain to be enacted with retrospective effect. Will you make provision? Yes. Right. But if it is from prospective effect, maybe you are not going to get affected right now, then you are not required. Gain from expected disposal of the asset. So while estimating the amount of provision, if you think you may gain some amount, you may make some profit on disposal of some asset, ignore it. Here they are applying concept of prudence, because this is a future event. Unless you actually dispose the asset, you will not consider the gain in the calculation of amount of provision. Okay. Can we use present value in estimating the amount of provision? This standard says yes, if and only if the effect of discounting is material. Normally, if you have to make some payment after 1 year, more than 1 year, then you can discount it. Okay. What about the discount rate you will use? They are saying discount rate to be used is pre-tax discount rate. Discount rate is pre-tax. What is pre-tax? Suppose interest rate is 10%. Tax rate is 30%. So post-tax rate will be 10 into 1 minus 0.30, 7%. For the purpose of estimating the provision, I will use 10% pre-tax rate, not the post-tax rate. The reason is simple. The cash flow that you are estimating is also pre-tax. The provision amount that you are estimating is also pre-tax. You don't estimate provision net of tax. You estimate gross amount of provision. Okay. So matching concept. Provision amount is pre-tax. Discount rate is pre-tax. And while estimating the discount rate, take into account the current market assessment of the time value of money. That is, what is your time value of money today, and also any risk specific to the liability. So risk can also be incorporated in the discount rate. Normally for you as a student, these figures are provided to you. After qualifying, you have to work on this number. So this will be the time value of money. Let's say government bond rate is 6%. Risk premium for the kind of liability, let us say that is 5%. So you may use 6 plus 5, 11%. That does involve subjectivity. There is no foolproof formula to know exactly what discount rate we need to use. Because this term risk itself is a subjective term. For you, doing this kind of professional course is not at all risky. For outsiders, ask them. Now next is when discounting is used. The carrying amount of provision increases in each period to reflect the passage of time. This we have done in one chapter, IAS 16, provision for decommissioning. You are going to incur 40 lakh rupees after 10 years, for example. So first you will make provision here, which will be present value of 40 lakh. Let us say that amount comes to 20 lakh only. Every year you are going to increase it by multiplying the opening balance into that discount rate, so that at the end of 10th year the book value will become 40 lakh, and this amount you will call it as interest or borrowing cost and recognize it in the profit and loss account. Now you student, you know this word reimbursement better than me. Yes or no? Do you claim reimbursement? Not allowed. Why you are not allowed? Policy of the company. Otherwise this will become your income from other sources. Income from other sources, or in your statement of profit and loss account, other income. So some companies tell their employees, not related to this chapter, that you first go to the client place, take an auto, take a cab. After you reach there, take the reimbursement from the accountant there. That means first you incur the expenditure, then other party will pay you. In business also it happens. You are a dealer of television set. So you will give warranty to your client, customer, but you are not going to pay from your pocket. You have not manufactured those TV sets. So normally your supplier or your manufacturer gives you reimbursement. Other example, you can take an insurance contract. Insurance company will indemnify the losses. Okay. So many times there are other parties who compensate us in case if we suffer any loss or expense. This is called reimbursement. Can reimbursement be recognized in our books as an asset? Yes, but there is a condition. There must be virtual certainty that reimbursement will be received by the obligation when it settles the obligation. So this standard is very stringent when it comes to reimbursement accounting. It says only if you are virtually certain, means all absolute certainty, no doubt. Is it more than 50% or close to 100%? Close to 100%. I will come to the class is virtual certainty. You will come to the class is probable. Not highly probable. So that is the difference. It is almost certain, absolute certain that it will happen. Then what entry will you pass for reimbursement? Reimbursement receivable to profit and loss, and it will be shown as a deduction from expense, provision. Okay. Amount recognized should not exceed amount of provision. So there is a upper limit on how much you can recognize as reimbursement receivable up to the extent of provision made. And the presentation in the SOPL, it will be shown net of the expense. and in the SOFP, it will be shown separately as an asset. Liability will be shown separately, asset will be shown separately. This is how they have defined the presentation requirement. So now, based on our discussion so far, we will take few questions. Under a new rule, an entity is required to fit smoke filter to its factories by 30th June 2014. The entity did not fit smoke filters during the accounting period. Till the accounting period 2014-15, as per the law, the annual fine for not fitting smoke filter is rupees 1 lakh and the cost of the smoke filter is 20 lakh. Should the entity provide for the fine and the cost of the smoke filter, or both? Very good question. Should you make provision for rupees 1 lakh or should you make provision for rupees 20 lakh? 1 lakh only. Why? You will think what is more profitable, by paying a penalty of 1 lakh rupees. So you can see, you can use this 20 lakh for 20 years. And if you invest in government bond, every year out of interest you can pay your penalty. This is how a CA will think. Is it right? So the entity would make a provision for the fine. Because you don't have an obligation to purchase the filter. Government says if you don't purchase, we'll charge you the fine. And you are happy with that. Is it right? So the entity shall not provide for the cost of the smoke filter. A fine may be levied for non-compliance with the rule. So the entity shall provide for a fine of rupees 1 lakh. What if the fine was 25 lakh? Then probably the company would fit the smoke filter. That will be simple. Now this question, is the answer given in your notes? That is why you are answering so fast today. Because of the introduction of a new accounting system, a company is required to retrain its staff and change in accounting software. The estimated retraining cost is rupees 5 lakh and the cost of change in software is rupees 15 lakh. The company proposes to undertake the staff training, retraining and change in software over the next 2 years. Now this is an interesting question. Should the company create any provision? Now this time, is there any penalty if you don't undertake the staff retraining program? That is your voluntary requirement. If you want to serve your client better, it is better let your staff get retrained, but that is always voluntary here. Then we have to see, is there any present obligation in this example? No, because I have not undergone the staff training, right? I am not obliged to make any payment. There is no past event, and on the reporting date, there is no outflow of resources. So therefore, a company need not make any provision. It can, you have to see, can it avoid this payment? Yes, you can. What you do, tell your staff, go to YouTube, okay, and learn yourself. This year our budget is very tight, okay. You can avoid that cost. So the answer is no provision is required for staff retraining and software changes as there is no obligating event. So the first line, that there must be a present obligation arising out of a past obligating event, that condition is not fulfilled. Other conditions like outflow of resources is also not fulfilled. Now one more question. Dry docking expenses of ship. A ship requires dry docking every 3 years for renewal of sailing license. You have to completely overhaul the ship, otherwise another Titanic will happen. Okay, but that is the legal requirement. Dry docking expenses is rupees 40 lakh. should the ship owner provide for 1/3 of the dry docking expenses every year? Is there a present obligation arising out of past obligating event? The answer is no. After 3 years, you have a choice. You may not go for dry docking expenses. You can sell the ship only and buy a new ship. So these expenses can be avoided also. So there is no present obligation arising out of past obligating event, and hence no provision is required. Now, one example, court case, 20 people died as a result of food poisoning from the product. Don't eat so much. Sold by the entity in a conference. So normally in conference, when food is free, people overeat. Legal proceedings have been initiated. Yes or no? Including me also. Legal proceedings have been initiated seeking damages from the entity, but it disputes the liability. Which entity? The one who has supplied the food, caterer. Okay. Up to the date of approval of the financial statement for the year to 31st March 14 for the issue, the entity's lawyers advise that it is probable that entity will not be found liable. However, when the entity prepares the financial statement for 31st March 14, the lawyer advised that owing to the developments in the case, it is probable that the entity will be found liable. Now the question is, should we create provision in 1314 and 1415? Only 1314? Only 1415? Both? None. Which answer is right? Suppose MCQ comes on this. Only second. First year there is possible obligation. First year there is possible obligation because the lawyer says that company will not be found liable. So there is a less than 50% probability that the obligation exists. But now the lawyer himself says, since he must have collected his fees, that now the company will be found liable. So there is a present obligation in the second year. Past event, as you can see, food poisoning resulting into death of some people. Reliable estimate can be made. That assumption you will always carry. Okay, that reliable estimate can be made. So you have to settle with this 20 people family. Okay. Now next is legislation virtually certain to be enacted. An enterprise in oil industry causes contamination but does not clean up. This we have discussed. Can we move ahead? Yes. Refund policy. They can convert this into MCQ question also. That these are the 4 possible answers. A retail store has a policy of refunding purchases by dissatisfied customer, even though it is under no legal obligation to do so. The standard says provision can be due to either legal obligation or constructive obligation. But its policy of making refund is generally known. That means there is a constructive obligation. It has created expectation amongst the customer that in case if we are not satisfied, company will refund our money. Should it make provision for refund amount? Yes. In some exam question, they give you number also. That company has a policy of refunding within 30 days. So what you will do, at the end of the year, last 30 days sale you will take and multiply by the probability, that is 10% customer will ask for refund, 2% customer will ask for refund, and multiply by that amount. That is the amount of provision you will have to make. In this question, there are no numbers involved, only conceptual test. Present obligation exists as a result of past obligating event. Then an outflow of economic resources embodying economic benefit will be required to settle the obligation, because some amount you will have to pay or you have to give them goods in return, and provision will be required on the basis of best estimate of the cost of refund. Okay. Now, one important question. Sun Limited has entered into a sale contract of rupees 5 crore with X Limited during the financial year 9-10. The profit on this transaction is rupees 1 crore. So that is your expected gain. The delivery of the goods to take place during the first month of 2010-11 financial year. In case of failure of Sun Limited to deliver within the schedule, a compensation of rupees 1.5 crore is to be paid to X Limited. So what is the contractual terms? It's contractual. In case if you do not deliver, then you will have to pay 1.5 crore to X Limited. Sun Limited planned to manufacture the goods during the last month of 2009-10 financial year. As on the reporting date, that is 31st March 10, the goods were not manufactured, and it is unlikely that Sun Limited will be in a position to meet the contractual obligation. Right? Question is, should the company provide for this contingency as per IAS 37? And should the provision be measured as the excess of compensation to be paid over the profit? So what is the amount you will have to make provision for here? Is there any present obligation? Yes, because the company says we will not be able to meet the contractual obligation. The contract says if you can't deliver within the schedule, a compensation of 1.5 crore will have to be paid. There is a past event. What is the past obligating event? Contract. Entering into a contract. Can we make a reliable estimate in this example? Yes, 1.5 crore. Outflow of resources, 1.5 crore. Make provision. In second question, the students sometimes go wrong. They said, yes, we can make a calculation as follows: 1.5 crore compensation, 1 crore rupees profit, so net compensation 0.5. Is it right? While making estimate, do not consider the expected gain. Okay. So this way you have to write the answer. Read it as homework. Will you read? Have you understood? Full provision will be made. Now we will discuss about onerous contract. Onerous contract was discussed in scope paragraph. In IAS 37 is applicable to onerous contract, even though they are executory contract. Even though they are onerous contract applicable. Okay. Why onerous contract? Because here the benefit that we will get from the contract is less than the cost that will be incurred to meet the obligation under the contract. So the standard is very harsh here. You will have to make full provision. Okay. Although some authors, some thinkers have criticized this paragraph of this standard, but right now this is how it is. Onerous contracts are contracts in which the lower of the below exceeds the flow of economic benefit from a contract, cost of meeting the obligation under the contract, or penalties, compensation arising from non-fulfillment of the obligation. Suppose you have to pay 20 crore if you meet the obligation, but you go to the other party and say, no, I want to cancel. He says you can cancel it for 18 crore. Which figure you will take? 18, because then you will be happy to pay 18 crore. And the benefit from this contract is only 10 crore. So the standard says you will have to make a provision of 8 crore a year. Is it right? If the entity has a contract that is onerous, the present obligation under the contract shall be recognized and measured as a provision. So now one important question appearing before you. In professional exam, this question is very common. And a similar example is given in the standard also. Mini Limited took a premise on lease on 17147 for rupees 2 lakh per month. The lease is operating lease. During March 2008, Mini Limited relocates its operation in a new factory building. Okay. So the story is, it has a small factory. Now it has shifted to a bigger factory. Okay. The lease on the old factory premises continues up to 31/12/10. And this lease is on 147. When did it relocate? March 2008. 2 lakh per month. The lease cannot be cancelled and cannot be sublet to another user. The auditor insists that the lease rent of balance 33 months up to 31/12/10 should be provided in the accounts for the year ending 31st March 2008. Mini Limited seeks your advice. Should they make provision? How much? 33 months into 2 lakh. 66 lakh rupees. Okay. And whenever you are going to make this payment, your provision account will be debited every year, and that account will close after 33 months. So this standard is quite harsh here, because you are required to make provision even for 2009, 10 and other years. If an enterprise has a contract that is onerous, this contract has become onerous because there is no economic benefit. Economic benefit is zero. And the cost of fulfilling the obligation would be 66 lakh. The present obligation under the contract should be recognized and measured as provision. In the given case, operating lease contract has become onerous. In the exam, first you write the provision, in case if it is a 4-mark question. Then write why it has become onerous. Economic benefit is nil, but the cost to fulfill the obligation is 66 lakh. Hence the company will have to make a provision of 66 lakh for the year ended 31st March 2008. Okay. One more question, number 12, note down homework, which is same as previous problem. Only numbers are different. Question number 13. Oh, this time you have to write the answer. An entity has a contract to purchase 1 million units of gas at rupees 2,30,000. The current market price for a similar contract is rupees 1,60,000. Company has a sale contract with a third party to sell gas at rupees 1,80,000. Should the entity create a provision under IAS 37? What is the cost of meeting the obligation? 2,30,000. What is the economic benefit from this contract? You will be able to sell it to a third party at 1,80,000. How much is your loss here? 50,000 or 70,000? You will take 180 or 160? 180, because we have a contract to sell it at 180. So therefore the answer is, it is an onerous contract. Write down. Right. You don't want to write. It doesn't depend on your choice. You have to write. It is an onerous contract. The economic benefit is 1,80,000. Cost is rupees 2,30,000. Therefore, the company should make a provision of rupees 50,000. Now, why 150,000? Write in bracket. That is 2,30,000 minus. We will take 1,80,000 because we can sell it for 1,80,000 to a third party. There is a sales contract also. In the exam, you have to first write the provision of the standard. If a contract becomes onerous, the company should make a provision. Then why it has become onerous, and then how much provision is required. Okay, try one more. This time you will try. An entity has a contract to purchase 1 million unit of gas at rupees 2,30,000. Current market price of similar contract is 1,60,000. The gas will be used in generating electricity, and the electricity will be sold at a profit. My question is same, whether an entity should create a provision under IAS 37. Vote for yes. It should create provision. Vote for no. It should not create provision. Which is right? The answer is it should not create a provision, because I am going to use it in producing electricity, generating electricity, and electricity will be sold at a profit, means I am going to recover the cost, right? So the answer is, since electricity will be sold at a profit, write down one line, since electricity will be sold at a profit, it is not an onerous contract. It is not an onerous contract. Now next paragraph is on reimbursement. We have already discussed. What you do, directly come to the question. Again, an important case study. (15) number. Very important. This can be a part of a bigger question, which with many other calculations also. Shyam Limited, a public sector company, provides consultancy and engineering services to its client. Very good. In the year 10-11, the government has set up a commission to decide about the pay revision. The pay will be revised with respect from 1/1/2006 based on the recommendation of the commission. The company makes the provision of rupees 680 lakh for pay revision in the financial year 2010-11 on the estimated basis as report of the commission is yet to come. Good or bad? Yes. It has made a provision. 680 lakh. No problem with that. As per the contract with the client on cost plus job. What do you mean by cost plus job? The contractee will pay you the cost plus some profit margin. Is it right? Whatever cost you will incur, he will reimburse you. He'll pay you. And he will give you a profit margin. That is cost plus system. The billing is done on actual payment made to employees and allocated to jobs based on hours booked by these employees on each job. So you are a consultancy service and engineering service company. You are providing service to your client. Client pays you on the basis of cost plus job, means cost plus profit margin. What happened? Government has appointed a pay revision committee. or commission, and they said that you will have to pay more payment to your worker. Company will have to now pay 680 lakh rupees more to its employees. The company discloses through notes to account, salaries and benefit include the provision of 680 lakh in respect of pay revision. This is right, because all conditions of provisions are satisfied: present obligation, past event, reliable estimate, outflow of resources. The amount chargeable from reimbursable job will be billed as per the contract when the actual payment is made. The accountant feels that the company should also book or recognize the income of 680 lakh. Recognize the income? Is it an income or reimbursement? In P&L account as per the terms of the contract, otherwise it will be a violation of matching concept and understatement of profit. Then what is the question? To comment on this note, you have to comment on this view taken by the accountant. Should they make a provision of 680 lakh? Yes or no? First you make provision 680. Mistake in this accounting policy is they have not made provision for, or they have not recognized reimbursement. In such kind of contracts, it is virtually certain that your expenses will be reimbursed by the client. They should recognize reimbursement receivable also, not exceeding 680 lakh. However, reimbursement receivable will not be shown as an income. Rather, it will be shown as an deduction from expense. So, accountant is partially right. He says you should recognize reimbursement to ensure matching concept. But accountant is partially wrong here. It will not be shown as income. Rather than it will be set off against the expense. Okay. Now one more question. This is somewhere towards the end of this chapter. X Beauty Solutions Limited is selling cosmetic product under its brand name B, but it is getting its product manufactured from Y Limited. It has an understanding with Y Limited that if the company becomes liable for any damage claims due to any injury or harm to the customer of the cosmetic product, 30% will be reimbursed to it by Y Limited during the financial year. A claim of 30 lakh becomes payable to customer by X Beauty Solutions Limited. How should X Beauty Solutions Limited account for the claim that becomes payable? So you will recognize 30 lakh provision. You will also recognize reimbursement receivable. 30% of 30 lakh. 9 lakh rupees. So you will show in your profit and loss statement 20 lakh rupees as expense. Net of reimbursement. 30 minus 9. So X Beauty Solution Limited will get reimbursement of 9 lakh. We will assume that it is virtually certain. So X Beauty Solution Limited should make a provision of 21 lakh. 30 lakh minus 30% of 30 lakh, 9 lakh. In financial year and disclose a contingent liability of 9 lakh. The contingent liability is recognized keeping in view the fact that in case Y Limited does not pay, then X Beauty Solutions Limited will be liable for the whole claim. So this also you can disclose. Next part is disclosure relating to provision. So this will complete our discussion on provision. Disclosure aspects include, disclosure relating to provision. I'll just go through it quickly, very simple. For each class of provision, For each class of provision, disclose opening balance, addition, use of provision, closing balance. Means your opening to closing whatever pluses and minuses you have done. Then if you have written back any unused amount, disclose it. Any brief description of the provision along with major assumptions made. An expected reimbursement recognized as an asset. Effect of unwinding the provision. For example, when provisions are created for dismantling PPE initially is unwound at each subsequent reporting period. So this is that borrowing cost on opening balance of provision wherever you have discounted the provision. Part 2 of this chapter. Contingent liability. Okay. The standard has three aspects: provision, contingent liability and contingent assets. Now quickly from your 12th standard accounts book, what is contingent liability? Same continues till today also. Come on. Outflow is remote. A provision whose amount cannot be determined. Okay, or that's it. No, it's not covered. Present obligation, past event, reliable estimate, outflow of resources, embodying economic benefit. So suppose this is yes, this is yes, this is yes, but this is no. Then the conclusion is it is a contingent liability. This is yes, this is yes, this is no, this is yes. Contingent liability. Yes, 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 this is no. Then also contingent liability. Right. So which means basically if it is not a provision, an obligation which is not a provision, which you cannot account as provision, most likely it will be disclosed as contingent liability unless the outflow of resources is remote. Outflow of resources is remote means there is no chance that you will have to make any payment to anyone. Okay, then don't even disclose it as a contingent liability. Is it right? When there is almost zero probability that you will have to make the payment for that obligation because somebody else may have taken the entire responsibility of making the payment, you don't need to even disclose it as a contingent liability. But normally we insist the client companies disclose at least. Why do you think we need to disclose when I am not recognizing it? This question they ask me in the interview also when I pass the C exam. Why do you need to disclose? At least the user of financial statement should know that there is a contingent liability, a liability which may arise on happening or non-happening of one or more uncertain future event not wholly within the control of the enterprise. Right, that was the definition. You said some piecemeal definition. Anyway, so suppose court case is going on. Court case is going on and the government has demanded 10,000 crore rupees from the company because you have not followed certain provision of the law. Company is contesting the case. Right now the case may be in the initial stage and we don't know what will be the outcome. But you know there is a demand of 10,000 crore. With every passing day the interest will keep on getting added to that number. Don't you think you should disclose to your client that there is a demand of 10,000 crore rupees from the government? In case if we lose, we may have to pay with interest and penalty. And if you pay such a huge amount of money, which is more than the cash flow that you have generated for the entire year, company can even be liquidated, wound up, or the ultimate stakeholder at that point of time will have to take that hit, because company's EPS will become negative, share prices will crash. Okay, company can go into liquidation also. So this is known to the investor when you disclose it. Knowingly, if he takes a decision, it is his choice. During mergers and acquisitions also, when a company wants to acquire other company, they want to be sure that I know what are the liabilities also I am taking. Okay, there should not be anything which comes later as a surprise. So therefore, the standard setters, keeping that in mind, they have defined contingent liability and disclosure, even if you don't recognize it. So just quickly read the definition of contingent liability. There are two definitions. First definition is what is normally taught in our 12th standard accounts book: a possible obligation that arises from past event and the existence of which will be confirmed only by occurrence or non-occurrence of one or more uncertain future event not wholly within the control of the enterprise. Court case is going on, we don't know what will be the outcome. But sometimes, okay, even though it is a present obligation in these two cases, first definition is this one, but second definition is for these two situations, when even though it may be a present obligation, but it is not recognized as a provision because either you can't make a reliable estimate or you don't have outflow of resources. Okay. So the second definition says a present obligation that arises from past event. Past event is common in all the three columns. Did you notice that? But it is not probable that an outflow of resources embodying economic benefit will be required to settle the obligation, or means both are not required. Either this is enough or this is, or a reliable estimate can be made. Now we'll continue tomorrow.